Hey everybody, Hutch here with bankingtruths.com, and I have an update for Ohio National policyholders. If you don't have an Ohio National whole life policy, you probably want to watch our best whole life policy for 2022, especially since the game has changed and there's a new set of players with a new set of designs that you're going to want to check out. But Ohio National people, you guys have a whole life policy. You know they got bought out. They're demutualizing, meaning policyholders used to own them. Now they got bought out by some separate entity, meaning they owe you money because you are part owner in the policy and you have some decisions to make. So the first decision is, do you take a cash buyout or do you take an extra dividend inside your policy? And we think we have a pretty clear answer to that. If you plan on keeping the policy, taking the dividend is basically essentially almost the same amount, plus it props up a certain amount of PUA or paid up death benefit. And so why wouldn't you just do that? And some of you were saying, well, I might need the money. Guess what? Borrow against the policy while having that money working for you. And we can show you a way to where it is actually a net positive for you. Usually. Depends on how your agent designed the policy. But most cases, we've seen a lot of cases from our existing clients who have these policies. In most cases, that can make sense. Now, the other option you have is, do you just cash out this policy because the Ohio National is decent now, but it's going to be a sinking ship? They're going to keep watering down the dividend. So do I cash it out? Or do I do a 1035, which is like a rollover to a new insurance product that you can sell me, Hutch? And I'll tell you this, insurance agents love 1035 because they're just so easy. Like, you don't even need to pay any money, Mr. Client. Just roll your old stuff to my new stuff and you're happy and I get paid, rah, rah, rah. But we're finding a lot of times this doesn't make sense, or it takes about, call it 7 years, 10 years for you to kind of break even. So I don't think it's the best option unless you have one of those really poorly designed policies, which is in the rarity of cases, but it does happen. There's also a third option, which is kind of a hybrid of the first two that we invented called the Ohio National Rescue Plan. So instead of doing a true 1035, or instead of just cashing out the policy, you actually start a new policy from a true mutual company over here, and we design it with the lowest amount of base and the most amount of term rider and PUAs. So it actually ramps up pretty quickly. And what's great is you actually use the equity in your Ohio policy while keeping it and earning positive arbitrage like we talked about. And how you do that is not using the Ohio National loan, which is, it's a good loan rate. It's 4.4%, but we can get you a loan with an outside lender who has a turnkey program. They accept Ohio National policies, and we get you a loan right now for 3%, sometimes maybe even a little lower depending on how big your policy is, but let's just call it 3%. If your Ohio National policy is earning, say, 3.5%, or even if we did an RPU and we showed like the absolute guaranteed no dividends ever, it still earned 3.3%. Isn't that greater than the 3% you would borrow against? So in doing so, this hybrid option is better than just cashing it out. Because if you cash it out, first of all, you won't find a safe place to put it to earn 3.3%. You probably won't even find 0.3%, the difference between the two. Not to mention, if you kept the policy and we did an RPU, it props up kind of this paid up, I'm not allowed to say free insurance, but paid up insurance where no further payments are due. And if it essentially acts like a muni bond paying 3.3%, well, that's great. So if you can borrow against it at 3 and move money over to a new policy that is going to actually perform in the realm of, call it 4.5 to maybe even 5. We're actually seeing that in this low dividend rate environment. And if you believe that interest rates will go up, we can't illustrate it, but we have done another video where we see an old policy and how it was illustrating like now about 4.5, closer to 5%. And it actually did a whole 2 points higher as interest rates rose and then even shrank below where it was, but just from that little spike, those dividends keep compounding within the policy, which kind of snowballs the whole thing. So going back to this hybrid, if you start to just slowly move the equity from your existing policy, still collecting positive arbitrage from there, we ramp up the policy to where soon you're collecting positive arbitrage on there, usually by year 3 or 4, to where it totally outpaces even the depressed performance of the Ohio. It wouldn't be a permanent thing because we're finding with the Ohio policies, they seem like actuarially when they hit 65, they kind of get watered down. And this is kind of across the board. We're seeing this. So what you would do is you still need coverage anyway. So if you have enough runway till age 65, whether that's 7 years or 10 years or 15 or 20, if you just move the equity over from the whole life policy where you're not paying out-of-pocket premiums there, the money you were paying out of pocket, you pay to this new policy that's ramping up. Essentially, the loan that is encumbering the whole life policy, essentially you could just transfer that to the new policy to where it is now sustainable, it's ramped up, it handles itself. And then we have this exit plan for the Ohio, all the while you're collecting positive arbitrage, to where instead of cashing it out then, you do a 1035, not to a life insurance policy because you're older, it's going to be harder to qualify, but you can actually, the law says you can 1035 to any kind of retirement annuity. And then even if you have more gains than what you put in, it's not a taxable event. You can 1035 that into a retirement annuity, which may not be ideal right now in this environment because interest rates are low. And annuities are better the higher interest rates go, which a lot of my clients think they're going to be higher in the future. Probably kind of have to be. But also annuities are better, at least the retirement income that they can guarantee you gets better the older you take it. So we'll have a lot of options, and we're not even recommending a product for the annuity now. We don't know what products will be out then. But if we move the equity over to this new policy to the point where this new policy can handle the loan and get positive arbitrage over and above the loan rate, which we can model for you every which way from Sunday and stress test it and show you that you're probably going to be in pretty good shape if you stick with some of the top 4 oldest and biggest mutual companies out there. That can often happen. And then you can roll that old Ohio policy into one of these retirement annuities. And the beauty of it is you get the tax-free income from your basis. So with an annuity, it's not like life insurance where even if you put in $500,000 over your life and you take out $2 million, all of it's tax-free. With an annuity, what they do is they give you your basis back tax-free and they tax you on your earnings. But that Ohio policy probably will have a lot of basis. And so we're preserving that basis for you to have tax-free income. And annuities, regardless of what type, there's all types. There's SPIAs, there's FIAs, there's DIAs, there's variable annuities. There are these stripped down low fee variable annuities with index funds. We're not even saying which one to pick, but from a tax standpoint, when you move it over to one of these annuities, you eventually will want some tax-free income. And this can be a great way to get it because, again, the older you are and the higher interest rates are when you actually turn on the annuity income, the better it's going to be for you. So it's kind of like a wait and see with the Ohio. Make its highest and best use right now, which is really just getting that arbitrage over and above the straight safe growth, which we have usually been able to model for our clients. Unless, again, you have one of the most poorly designed policies, which we've seen, but it's in the rarity of cases. If you have one of those, maybe it is better just to cash it out or to do a 1035. But we're happy to do that analysis with you. What we recommend is schedule a meeting with us. We can instruct you on which in-force illustrations to order from the insurance company. We actually need a series of them. We need a control group, an experimental group, change a couple different variables. And when we do that, we can actually just show you the math. Here's what you do if you go this path. Here's what you do if you go this path. Here's if you keep paying premiums on it. Here's if you reduce paid up. We do all that stuff with you to where you can understand what the best thing for you to do is. And if it makes sense to get one of these new policies without having to do a 1035 and take a step back to take a step forward, we can actually have you getting positive arbitrage on both sides of the fence long term, which is really what you want and why you did this in the first place. So you have options. You've never done this before, so they're probably confusing to you. We do this a lot. Let us help you make a good decision. So again, scheduling link here, there, one of those places. Book a call with one of our team members and we'll get you schooled up on what to request from Ohio National and help you make a good decision. All right, we'll talk to you soon.